Like if you're a first home buyer, if you can save a bigger deposit, you're still going to be ahead, right? Because if you're competing with other first home buyers who don't have that deposit, you're going to have more flexibility.
Yeah, for sure. And if we start unpacking a little bit more around the scheme itself, so you've got your 5% deposit down, and normally if you only do a 5% deposit in general when you buy a property, you incur lender's mortgage insurance. And I've actually done that on a property before deliberately because I didn't want to put a full 20% deposit cash into it. But in this situation with the scheme, you put a 5% deposit in and then the government basically guarantees the other 15%. So you do not get hit with lender's mortgage insurance. And, you know, for people that don't understand that, can you maybe just explain, Billy, like how lender's mortgage insurance works in simple terms? Welcome back to the Winners Playbook. Josh here with Billy. Today we're going to be breaking down the latest first home buy changes in Australia. We're going to be covering off what's changed, who qualifies, how this plays out with state concessions and the traps to avoid so you can keep your costs down. But before we rip into this one, Billy, because it's going to be good, you are off to the US tomorrow, mate. So I'm sure you're looking forward to that. And what else is happening in your world?
Yes, stoked about that, Josh. Off to Boston, New York, and then LA with a whole big gang of Aussie advisors. So we're going to be meeting loads of people and doing some fun stuff as well. Then I get back, then I'm moving house a week later. So plenty going on.
Right, big month.
Huge month. Yeah. How about yourself?
Yeah, what's happening? Not off to the US, that's for sure. But I'm off to Singapore in a couple of weeks for a couple of days. And then I'll be over to the Philippines to see our team there. So I'm there for about a week or so, just looking at more around what we're going to be doing over in Singapore and a bit of a setup and things that we're doing over there and meeting a bunch of people. And then, yeah, to see the Philippines team. And besides that, yeah, just lots going on in the business, sort of coming to a close on some big projects, which is good. Had some very interesting breakthroughs around AI in the last sort of week or so, which we'll reveal as they come to fruition, hopefully. Had seen some really good tools that are pretty much going to change the advice landscape, I think, in terms of how it's done. So that's going to be absolutely amazing if that comes off. And yeah, we're absolutely rushing now towards the end of the year. You know, by the time you come back mid-September, you know, it's not long around and we're at Christmas. So
Massive.
yeah, it absolutely flies by.
Let's get into it. What are we talking about?
Yeah, mate. Well, first home buyer changes. This one's interesting. It's a very, very hot topic this week. I've got a lot of thoughts around it. So we will start obviously with the breaking down of what is it and what's kind of changed, because there has been a few changes. It's been brought forward. It was supposed to come in 2026, and now it's coming in as of the 1st of October. But if we break it down for the listeners, first of all, Billy, what is it and what has changed?
Yeah, so the first home buyer guarantee scheme, it was already in place, but it was quite restrictive, or it's quite restrictive now, and that all changes in October. So the major changes are there's unlimited places. So at the moment, you know, it fills up. Only so many people can do it. Unlimited places, no income test. So it does not matter how much you earn, what salary you have, anything like that. Anyone can do it who hasn't bought a home before. And the actual price limits, how much you can spend on a house, they're increasing dramatically. So for Melbourne, it's 950K, Brisbane $1 million, Adelaide 900, Perth 850, and Sydney $1.5 million. So big limits. And just to refresh people what this is, you just have to put down a 5% deposit and you don't have to pay lender's mortgage insurance under this scheme for those first home buyers. So pretty significant.
Yeah, it is. It really come a little bit out of nowhere, I suppose, with some of those changes, like the caps going up and no income limit whatsoever. Because all the ones historically that have been around, or some of them that are around, they've had those income limits. So it really sort of cordons off who's going to be eligible for it. But you know, you could be earning $1 million a year and still benefit from this first home buyer scheme. So it's really interesting. I don't know. I've been looking at a lot and thinking about it myself in the last week or so, just in terms of, is it a net positive or is it a negative? I don't know. What's your read, Billy? Like, where do you sort of sit on the pendulum there of the positive and the negative of it?
I think it's like all these policies, they're just designed to win votes, I think, because there'll be a handful of winners, right? People who earn a good income, but they haven't saved up a big deposit, they'll get in quicker. But it's going to be at the expense of other people trying to buy. Okay, look at Sydney, right? The limit's $1.5 million. If you're taking out a 95% loan on a $1.5 million property, that's a big home loan for a first home buyer. So that's only going to help very high income households who haven't got the deposit, right? And they're going to be able to outbid other people on that same property. So I don't know. It adds more demand as if we need that, but it doesn't help with the doesn't help on the supply side. So there'll be some winners, but there'll definitely be some losers out of this as well. That's what I think.
Yeah, I've seen a lot of buyers agents that we do a lot of work with as well, really talking about it and, a bit of conflicted thoughts on their side of things. But naturally, just in those price ranges, you can only expect things are going to heat up. In Melbourne, when the threshold was supposed to be 800 grand and now it's going to $950,000. So naturally, like you said, we haven't necessarily needed more demand because there's a bit of a lack of supply. But now the doors have opened even up for more demand and people to usher through the doors as well. So naturally, you can only think it's going to put more pressure on property prices in those brackets. And then you pour on top of that interest rates starting to come down. The ability to service a loan getting better so you can borrow more money. So, first home buyers are able to borrow more money, caps going up. It's a little bit of a perfect storm here. So what I'm seeing and hearing is a lot of investors, we have a lot of clients that buy around that, $600,000, $700,000, $800,000 mark. You couldn't be wrong in thinking that, well, if you get in soon around those price points, depending upon the state, once October 1st rolls around, there's going to be a lot of first home buyers trying to get in at the same market. And naturally, it's going to start pushing prices up. So I think there's an investment play there, and a lot of investors are probably considering that if they're going to be buying properties or were thinking about maybe buying properties over the next 6 months, they might consider speeding it up if they're looking around that price bracket, because once that comes in, naturally more buyers going to be on the market and it's just going to push up prices is, in a simple term, the way I view it. What do you think about that, Billy? Do you have a similar belief, or what do you reckon?
Yeah, I think a lot of houses are going to push up towards that cap. But the funny thing is the cap it's like a hard limit, right? So if you're buying in Brisbane and the first home buyer cap is $1 million, if you're not a first home buyer, you can just offer 1.01 and you'll outbid all those people that are trying to access the 5% deposit scheme. So there's going to be all sorts of distortions. Where if you've got a property with just within the cap, it's probably going to push right up to the top of that cap.
Yeah.
But maybe not much beyond that, because then once you're above that cap, then you're outside of the scheme, access to the scheme.
Yeah, it's a real interesting point that, like, God, how much would it suck to miss out on a property if you're a first home buyer and you're in Melbourne and you've got your hard limit at 950 and then it goes at auction for 955.
Yeah, or $950,001, and you're done.
Yeah.
You're cooked. You can't bid a dollar above that.
There's going to be a bit of that going on, I reckon. I reckon there'll be a few people that actually miss out on some properties exactly in that sort of a fashion, and they will not be able to budge above it because they wouldn't have a deposit ready to go. They won't be locked and loaded.
Yeah, yeah. So that leads us into, like, if you're a first home buyer, if you can save a bigger deposit, you're still going to be ahead, right? Because if you're competing with other first home buyers who don't have that deposit, you're going to have more. Yeah, you're going to have more flexibility.
Yeah, for sure. And if we start unpacking a little bit more around the scheme itself, so you've got your 5% deposit down, and normally if you only do a 5% deposit in general when you buy a property, you incur lender's mortgage insurance. And I've actually done that on a property before deliberately because I didn't want to put a full 20% deposit cash into it. But in this situation with the scheme, you put a 5% deposit in and then the government basically guarantees the other 15%. So you do not get hit with lender's mortgage insurance. And, for people that don't understand that, can you maybe just explain, Billy, like how lender's mortgage insurance works in simple terms?
Yeah, it's basically if you don't have a 20% deposit, like you've got a 15, 10, 5% deposit, the bank will make you pay lender's mortgage insurance. And that insurance is not there to protect you, it's there to protect the bank. Like, it's an insurance policy whereby if you default on your loan and the bank has to sell the property, if if you don't get a good sale price, right, and like they sell the property, it doesn't cover the loan, it doesn't pay off the loan, that insurance covers the gap.
Yeah.
So it means the bank's going to get their money back, right, regardless of how much the house sells for. LMI can be pretty expensive, right? It can be like what, 20 or 30K. And usually you'd put that on the loan, you would borrow that. So it just means, you put down a 10% deposit, you borrow 90%, you got to pay LMI as well. So often that'll just be added on top of the loan. You'll have a bigger loan.
Yeah, and you're not wrong. It can be expensive. I did some figures before, doing some numbers on a, 1.5 mil. Let's go right to the top at Sydney. You go 1.5 mil, and what would be your lender's mortgage insurance on that if you had a 5% deposit? It'd be 75 grand would be your lender's mortgage.
So that much?
Huge. 75 grand. Yep. And Melbourne, if we go to the top, so 950K, or Victoria, 950K purchase, you're saving LMI of about 38 grand in that situation. So when you can go on the loan, the LMI calculators online and have a play around with it. But generally when you start to push over a loan to value ratio of like 88 and 90% is when LMI starts to really get nasty in those levels. Like if you're at a loan to value ratio, and if people listening don't understand what a loan to value ratio is, that's where basically say you've got $1 million property, that's the value. And if you've got a $800,000 loan, the loan to value ratio in that situation is 80%. So you don't incur any lender's mortgage insurance. But if the loan is a little bit higher, say at $850,000, you're at an LVR of 85%, and therefore you're going to start incurring some lender's mortgage insurance. But in those lower tiers, it's not so bad. But when you start, if we talk about you only put down a 5% deposit, which I don't think I've actually ever seen someone really do.
We'd never recommend it. That fee's just massive. Like we took clients, if you can't get at least 10%, then you're not ready.
Yeah, I totally agree. And there's other ways of doing it though, mind you. Like I've had clients that have essentially bought properties without putting money down because they had equity in another property and they pulled that out, but they used that to cover the 20% of the stamp duty. So they didn't have to incur lender's mortgage insurance. Because as you said, it's not protecting you. It's just basically protecting the bank, and it gets added onto your loan. And then if you factor in the interest on that guy over 30 years, it's not 65 grand that we just said in the Sydney example. Like that could be pushing up a hell of a lot more that you pay back over that period of time. So that's, I suppose, one, it's a benefit of the scheme, is that it's avoiding you from paying that lender's mortgage insurance. But really the big question there is that means you are taking on more debt. Like you're only putting down a 5% deposit. Like you just said then, Billy, like we never tell a client to do that. Like we wouldn't tell a client to just go 5% in on a property, particularly if it was their first property. So, when you think about that, like it's the scheme itself, it could put a lot of pressure on people. If you're borrowing 95% of your loan, in that same example, that Sydney property at 1.5 million, you'd be paying 100 grand a year in loan repayments on a 95% lend on 1.5 million, and on a 95% lend on our Melbourne scenario, so a 950K property, you'd be paying $63,000 a year in that scenario. So I don't know, you got to be on some big incomes to still have time to live outside of that. So I don't know how, good all in all it really is when you consider that. It's
it begs the question, right? If you can afford $100,000 a year in home loan payments, but you can't save a deposit,
there's problems.
So should you really be taking out a $1.4 million mortgage, however much it is?
Yeah, well, it leads you to believe there's other problems in their life. Like they're clearly not managing their cash flow efficiently whatsoever. And then is it a good idea to get into debt and then run the risks of defaulting on a loan? And I've seen that happen before. And then you screw up your credit and all of these things, and it spirals out, or property doesn't grow, or whatever it may be. I think there is a lot more to it. And I think if you had a 5% deposit and good income and stable cash flows, maybe I think you've got to really look at your numbers. I really think people got to actually look at their numbers on a loan here, because it's a big borrow, and, property doesn't go up in a straight line as well. Before we hopped on here, Billy, we were talking about like negative equity. And did you want to talk a bit about that, like negative equity, and what do we mean by that?
Yeah, well, this is where it gets murky. We'll talk about it in a second. Negative equity it's essentially where, you buy a property, And then the value of that property falls, and it falls to a point where it's below the amount of money that you owe the bank. So you buy a house for $1 million, you borrow 900,000. A couple of years later, the house drops in value, it's worth 850, but you still owe 900. So negative equity means if you sell the house, it's not even going to pay off the loan, right? And again, that's what LMI is for, to protect the banks in that situation. This is where I don't understand the scheme, in the sense that, has the government actually works this through properly? What if at some point in the next few years property prices fall and you have a whole bunch of people in a negative equity situation and they start selling? What's going to happen? What's going to happen to those homeowners, and how much cash is the government going to have to stump up and give to the banks?
Are you saying the government might not have fully thought through this policy, Billy?
There's a chance. Or maybe they're like, maybe they believe that, the Australian dream, property only ever goes up, so it won't be a problem.
Yeah, no, yeah, seriously, it's everyone in Australia like this. We do have this fascination around property. We obviously talk to clients around it a lot, and I don't know. Can you think of a period of time where you saw, because you've been in the game longer than I have? Did you? Can you think of a period of time where you've seen a bit of a material correction in property prices? Obviously, we had a little bit of a dip into COVID, but then that changed really quick, and property went on an absolute tear. Can you think of any examples?
I don't think it has. Like in the GFC, I think -10%, but that's averages. So certain locations, absolutely. Like in specific locations or specific property types.
Mining towns.
Of course, there's been much bigger falls than 10%. And a lot of regional areas, you can go 10, 15 years with no growth at all, right? Property prices are just stagnant. So it absolutely can happen.
Yeah, well, there's a lot, government's doing a lot lately, aren't they? Like, they've got this one, and, Division 296, which we were talking about on another podcast. They're really throwing their weight around at the moment. And yeah, like you said, I don't know how much they've fought through some of these areas. It's going to be very interesting to see how many people actually take up. I'd love to actually know the stats. I don't know the stats. I don't know if you know the stats either, Billy, like on how many, because weren't they capping it at 20,000 buyers originally, the scheme?
20 or 30,000, something like that. And I don't know how quickly that filled up, because I should speak to our broking team, but they always seem to be able to find places.
Yeah.
So I'm not sure.
Well, that's a point to also note as well. I think it's available with most banks as well. I think there's about 30 plus banks that the scheme's going to be available for. So there's obviously a lot of lenders around Australia, but all of the big banks are involved in this thing. But there's clearly a lot of choice around. Like when I think about it, if I was a first home buyer again, like I would probably use it. I think I would use it if I could, get in with 5%, but still have some money outside of that as well. So I don't go all in on the property, have a nice buffer there. And I think there's a bit of a play for the right people as well to consider. Maybe you get in for 12 months and then convert it to an investment property thereafter, and go on the rent vesting journey. So I think there's, for the right people in the right situation and circumstance, good way of getting into the market. You got good cash flows, and you got a bit of a savings buffer behind you. Well, make the use of what the government's providing you here. And if you can use that, and then, if we talk about some of the other, schemes around, you've got the stamp duty exemption or relief. That's obviously state-based though. That does vary between states. And then you've got the first homeowner grants. You can kind of start like stacking these government benefits into, it's like a Big Mac or something, just full of all these benefits, like stamp duty, first homeowners grant, 5% deposit. What more could you want, Billy?
Well, spot on. I mean, that's where I think the scheme is useful. You don't want to be, I don't think for most people you want to be near those price caps in this scheme necessarily. Like if you're, say in Melbourne, right, if you spend 600 grand, you pay no stamp duty. So if you're buying at that sort of level, you can go no stamp duty, 5% deposit, that's great. It's once you're up to that $1 million or so, you're talking about a pretty big loan, and you're still probably going to cop full stamp duty as well.
Yeah.
But yeah, you're spot on. You can stack this up with any other schemes that are going around.
Yeah, well, like when I bought my first home, my stamp duty didn't pay and got the first homeowners grant as well. And I think that, to me back then, that was worth about I think about 35 or 40 grand. So I'm from memory. I don't think it's changed a great deal. The stamp duty in Victoria, I think it's around 700 grand. It phases out or starts to phase off around there. So depending on the purchase price. So I guess that doesn't really help a great deal for this scheme that we're talking about, because that in Victoria kicks in at 800 grand. But you know, if you start looking at some of those, oh no, well, actually, no, it would apply in those scenarios, because that's just the cap. So if you're buying for under that, you're still all good. So yeah, there's the potential that you can go the first homeowners grant, which I believe is still 10 grand, isn't it, Billy? The first homeowners grant, 10 grand.
Yeah, it's only for new properties, so you got to build something.
Yeah, okay, so that can be a bit of an issue. And then your stamp duty, you get your relief on that, and you know, you're off and running at that point in time, aren't you?
Yeah, yeah, and there's some other murky stuff in here, and I assume this applies under the current scheme, but I'm guessing it hasn't sort of come up as an issue. But there's these clauses in here, like if you move out, if you use the scheme, move into the house, if you then move out, they can take that guarantee away. Like if you move out and say, oh, it's a rental property now, the government can remove that guarantee. And there's even a note here, the bank can then ask you to pay your LMI.
Yeah.
So I'm presuming it's something that hasn't actually happened, but it looks like they've snuck in a few clauses that the government could like pull the trigger on in the future. So you got to tread a bit carefully around that one.
Bit of fine.
So if you're wanting to game the scheme, like, oh, I'll do the 5% buy the house, then I'll move out or rent it out or refinance, you got to tread a bit carefully, I think, around those sorts of plans.
Yeah. I suppose like with any, you got to look at the finer detail around all of it, because it can't always be what it seems to be, and sometimes it can be too good to be true, which we're not saying this is obviously too good to be true, but yeah, there's definitely some details that haven't really been known or talked about necessarily in the headlines, I think, there, Billy, which you're right onto, which
Yeah,
maybe we can maybe we can uncover and do that in another podcast. But you know, if we talk about like the risks obviously going in with a small deposit, I think we sort of touched on some of this, like that high leverage situation, you know, can be dangerous. The negative equity side of things we've spoken about as well. And then, you know, the whole idea of, you know, what's the idea of this scheme is to help first home buyers get into the system sooner. But, you know, this is just going to start pushing up house prices. And so isn't it sort of, contradicting in a way that this system is to help more first home buyers get in, but then it's only going to probably put future first home buyers even more out of reach, because naturally prices are just going to push up again at this point in time. What do you reckon?
I think so. Like, I think it's likely to create this short-term surge in prices in those price brackets just below those caps. You know, there might be a little kick at 50, 100 grand in house prices in that range. But then what's that then going to do in 1 or 2 years' time? If they keep those price caps where they are, it'll just be like a short-term kick. And then what happens? Then you could see stagnant prices or even a pullback. So yeah, you're bringing forth, like, a few people will get in sooner, but it'll be a one-off sugar hit, I think.
Yeah, no, I agree. And look, you know what,
So it might help them win the next election. That's probably the main.
Yes. No, I think there's a bit going on there. But I'll be curious to know, like in other countries, what their sort of first home buyer incentives looks like, or is it more of just an Australian thing? I've honestly never dug deep into that one. Oh, you're in the US, so for the coming weeks, so I'll be curious to see what you pick up over there around it, because you know, getting into the housing market, like, it doesn't have to be the way you build your wealth. Like, you can build wealth in a lot of other ways as opposed to just getting into buying property. So I think that's that traditional route. And it's something I always talk about with my clients of, you know, how much you pick up from your parents growing up and what they do and say that totally rubs off on you. And if they're telling you to get in, buy a home as soon as you can and move out, I hear that all the time, and pay your mortgage off as soon as you can. I don't actually know if that's always the right way to do it. Like, I've got some clients I work with that are young, you know, got some really good businesses that are just going hard in their business and scaling and going to build immense amounts of wealth, most likely through that. Whereas if they put themselves into a property at the same time, they would probably tie themselves down a little bit, and it would actually hold them back in ways in terms of being able to invest hard in their business and be nimble and agile. Because when you get in and actually buy that first home, you're sort of locking yourself down into a location at that stage. And you don't want to transact in property often either, because you've got your stamp duty and other costs associated and getting in and out. Of course, if it's a home you're living in, it's, you can sell tax free at any point in time. But yeah, property's not one to sort of tread lightly with, and you've got to be careful. But there's nothing wrong with not getting into property as well. I think if you want to build wealth, you just have to be active in other areas of your life, whether that be through business or through non-property investment, going hard into the share market or whatever it may be. I think there's other ways of doing it. And that's why I'd be curious, Billy. I was just thinking, like in the US, like what sort of first home buyer incentives do they have over in the US relative, to Australia? She's obviously got a lot more big business and a lot more creativity, I would say, over in the US from a tech perspective. And a lot of the best and biggest firms are all coming out of the US. So, I don't think they do everything right, but I think they do some aspects of things good. They're obviously breeding some of the best and brightest minds and creating some of the best companies around the world, which we don't have here necessarily in Australia. So I'm not saying that relates back to, buying property in the first home buyer scheme, but obviously doing some things differently. I'm not sure. Are you across any of that, Billy, or?
Oh, yeah, I might ask a few questions when I'm over there. I know they do have a couple of big differences. Like your home loan, the interest is tax deductible.
Yeah,
Which is a
right.
pretty massive difference. And they've also, the other thing that's well known is their mortgages are pretty much all fixed rate for 30 years.
30 years, yeah.
So they had some weird stuff happen where you could take out a 30-year loan at 2% a few years ago. And now if you take out a 30-year loan now, it's like, 6-7%.
How good would that be? Yes.
Yeah. I'll have to dig into that.
Yeah, we've got some homework for you then, Billy, on your US trip. So you've
All right.
got homework to come back to the Winners Playbook on. But if we close out then talking a bit about buying in the next 6 to 12 months, if someone's listening, they're actually considering to go in on this, what steps should they then be taking before they jump in and make the move?
I think if you're going to use this scheme, having a 3 to 5 year plan is even more important because you've got less flexibility if you use this scheme. Like you're buying into a house where you're going to have bugger all equity, right? So you don't want to be, changing your mind and selling 2 years later. So you really need to have a plan. You really need to be buying this house that you genuinely intend on living in for a long period of time. So you need a plan. And if you've got a partner, that involves sitting down with your partner and carefully figuring that out. Next step, if you decide, yes, we want to buy our first home and we think we want to use this scheme, definitely need a gun mortgage broker. Because as you pointed out, there's only certain banks that do the loans for this. The interest rates might be different, right? You might have different access to interest rates if you're using this scheme. So you want to sit down with a mortgage broker and compare the scenarios. Okay, if we use a 5% scheme, what's the loan going to look like versus going the traditional method? That's step 2. And then step 3 is executing, and that might involve saving for a period of time or whatever it might be. But get the savings built up and make sure you've got a buffer.
Yeah.
And then go back to steps 1 and 2. Make sure it's still, this is the plan. Go back to the mortgage broker. We're ready to go. Let's run the numbers again.
Yeah, I think that's perfect, Billy. And that's a good point you raise actually around typically when you incur lender's mortgage insurance and you're borrowing higher amounts, the bank charges you a much higher interest rate. And I can say from experience, because I've done exactly that. Say the average interest rate on the loan is 5.5% on a home loan, but if you're incurring LMI, it might be 6 or 6.5% plus, because the bank's deeming you as more risk when you're taking on more debt. So that's an unknown actually. I'll be very curious to see for the banks, are they going to just apply the regular rates in this situation? That would be my assumption, because the government's guaranteeing it, and it's kind of like, but it is a 95% lend still. So yeah, going to be interesting to see, are you going to be penalized and paying, above market to what a normal borrower would be or not? So I guess we've still got some unanswered questions here, which will come out in due time. But 1st of October is only just around the corner. So
yeah, well, that's what stuck out to me. It said if you refinance, you can lose the guarantee. So you find yourself in a situation, you take out this loan and you're sort of stuck with that loan, even if the rate isn't competitive. You see a few things to look out for there.
Yeah, there's more detail clearly, and not everything that the government does is clear and transparent all the time. So I'm sure we'll figure out more as it does come out. But nevertheless, I think exciting times, and sort of talks to what we do as advisors. Things are always changing in the in the finance space. Like things are always changing, new schemes coming out, government's tinkering with things. So it definitely keeps us on our toes. All right, well, we might bring it to a close, Billy. You're obviously off to the US tomorrow. So like we said, we've given you a bit of homework to take away and come back to us when we see you next. So I won't have you on the Winners Playbook for a couple of weeks then, Billy, will I?
I'll have to find some special guests, I think.
All right,
I'm not that keen on dialing in at 3 a.m. or whatever it's going to be over there. So
no, we won't do that too, Billy. We'll find some subs in the interim. But of course, everyone, if you are getting value out of the podcast, leave us a review, like, and follow for more. And if you ever want to chat about your individual situation, come through to one of us as the advisors, or particularly if you're going to be looking at the first home scheme, you might be best chatting with the mortgage broking team at Link Wealth Finance. But until next time, Billy, safe flight tomorrow, mate, and we'll see you in a few weeks.
thanks, Josh.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.